Corporate finance practice problem using OneNote. Acquisition uneven returns problem number 1. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, you're going to be on the icon on the left-hand side, the Practice Problems tab, down in the 2013 Acquisition Uneven Returns Prob 1 tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top. We got the calculations down below. We're looking at an acquisition type of situation. One company then thinking about acquiring another company for a cost of $7 million for the acquisition process. Now note, when thinking about acquisition kind of situation, oftentimes we'll have similar calculations as you would see with a capital budget situation. Capital budgeting being something we looked at in a prior section, common tools being the net present value calculation and the internal rate of return calculations, given the fact that they deal with investments that will typically impact multiple periods into the future, such as purchases of large pieces of equipment or something like that. Clearly, if we're thinking about purchasing a whole nother company, then we also have a situation where it will be impacting multiple periods into the future. We can use those same kind of tools depending on what type of the acquisition we're looking at, including the net present value calculations and the internal rate of return. Therefore, if you want more information on those kind of calculations, take a look at the capital budgeting problems where we'll do those in more detail and go a little bit slower in the process. If you want more information on present value calculations, take a look at a present value section where we focus in on that, calculating the present value multiple different ways using tables, formulas, and Excel. So we have an outflow similar to a capital budget situation of the $7 million here. That's we're going to imagine starting at period 0. Then we're going to assume the benefits taking place. Now, obviously, if we're purchasing another company in total, the benefits might be even more outstanding or longer into the future, and there might be a lot more uncertainty as to what exactly are the benefits going to be with a complex type of scenario like that. So we'd have to estimate what the benefits or future inflows would be for us. We're going to estimate here that for years 1 through 5, we got cash inflow from the business that we're acquiring. If we were to acquire it, in other words, we'd have cash inflows, we're assuming, for the first 5 years of $710,000. We're also assuming we'll have other related benefits, cash inflows, $62,000. We can think of those as things that are going to benefit us and allow us to increase our performance, synergistic type of benefits, sometimes they might be called, if we were to engage in the acquisition. Noting that, of course, our general concept here, like with capital budgeting, will be to think about the cash inflows and outflows and think about whether or not it'll be a good decision-making process using a net present value type of calculation. From years 6 to 15, we think we're going to get cash of $926,000, related benefits $82,000. Years 16 through 20, cash inflows of $1,010,000 and $92,000 related benefits. So we're going to have to take a look at those cash flows. We want to basically present value them back to the period 0, compare them then to the $7 million, and see whether or not it'd be a good idea to do this. To present value them, we need to think about a rate to use, just like with the capital budgeting. We're going to use the cost of capital rate, which might be called the rate of return, the discount rate, the hurdle rate that we're going to use, noting that that rate does include the actual return that we want. This is not the interest rate, meaning if we calculate the net present value using this rate, that means we cleared this rate in the calculation if we get to an answer of 0 or above, which means it might be a good thing for us to do. If we get something negative, that means that we have not cleared the 11%. Okay, so that's why we might call it like a hurdle rate kind of thing. So we're going to say there's a couple ways we can do this. Now, you note that we have the 1 through 5 and the 6 through 15, 16 through 20. So that if you see those groupings, you might say, I should be using annuity calculations there, just from a present value kind of calculation method. And we can do that. We'll use that method as well. Or you might just say, hey, I'm just going to calculate this out years 1 through 20 and just do present value of 1 for each year. There are pros and cons to either method. There's no right way to do this. normal factors that you would be considering are, one, if you're doing this in the format of a book problem, they're probably doing this on purpose so that basically they can force you, especially if it's a test question, to use the annuity calculations that might be a little bit easier if you don't have like Excel or a financial calculator to be using. So that's one thought. And another is if you use the long format, if I use 20 periods, then I get to see each period one by one each year and the actual cash flow from it. That could be nice. That could be beneficial, although the downside would be that 20 periods is kind of a lot of data to be looking at. So if I was to use an annuity method, it might be easier for presentation purposes, which might be another reason you might do it that way. But if you're going to do it for presentation purposes, again, you can reformat the numbers in any kind of year format that you would want. So those are the general kind of things you would think about. We're going to do it both ways here. First, I'm going to take out 20 periods and just think about this, not doing the annuities. Just take it out 20 periods and do the present value of 1 for 20 periods and then add them up. Then we'll use the annuity calculation. So that would look something like this. We'd say, all right, we're going to just count out 20 periods here. And this would be quite easy to do in Excel. Obviously, it would take more work to do by hand. We do this problem in Excel if you want to take a look at that. And then we would have period 1 is going to be that 710,000, and we would do our present value calculations. We're just going to show the present value as it might be done in Excel. Note that if you want to work more on present value calculations, we have a whole section on that. We have a whole section on these capital budgeting problems that are similar to these if you want to look there as well. And the present value idea would be we're taking that 772,000, discounting it back at the 11% 1 year, because this is 1 year out, and we would be getting the 695,495. The formula in Excel, negative present value brackets. The B10 is going to be the interest rate, which we could see down here, the rate 10%. Notice we made it an absolute reference by putting a dollar sign before the B and the 10. That's so that if I copied this table down in Excel, this cell, the 11%, would remain the same. Then we have comma and PERs, the number of periods. Number of periods is reflecting a reference to a cell, which is this cell right here, and that has a 1 in it. So instead of hard coding the 1 year out, we have a cell reference because that will then move down to the number 2 when we go to the next period. Then we have comma, they have the payment. There is no payment because payment represents an annuity. Therefore, we have these 2 commas to get to the future value that represents or is the 772,000. Notice this does not have an absolute reference, no dollar sign before the F and the 3 because we're going to copy that down and it'll move down as you can see here to the next cell. Going to cell 2, we have the same 772 because we have this amount for the 5 years. By the way, the 772 represents the adding of the 710 of the cash flows and the other benefits that we're going to get, the synergistic benefits. So we get a total cash benefit, we're assuming, of the 772,000. That's going to be our estimate. So we have the same number there. We're going to present value it back at 11%, 2 periods. That's going to give us the 626,573. If we look at the formula, negative present value, the rate, once again, is that going to be that 11%, same cell you can see here because it has the dollar signs before the B and the 10, making it an absolute reference, comma, number of periods, now 2, because this is 2 years out. We did not hard code or type in the 2, but rather used the cell reference, which copied down automatically from E3 to E4 because it's not an absolute reference, comma, payment, no payment because this is not an annuity, and therefore 2 commas, future value, then the 772,000, which then moved down from cell F3 to F4. So if we follow this on down, we'll do a couple of these. We won't do it the whole way, but the next one, of course, 772,000 discounted 11%, 3 years out. We have a smaller amount, 564,480. And then we have the next one, 772 for 4 years out, discounted at 11%, 508,540. 5 years out, 772 discounted at 11% would be the 458,144. And then we have a different amount here because in year 6, we had the 926 and the 82,000 added together to give us that 1,000,008. So that if we discount 6 years out at the 11%, we're going to get that 538,918. If we took year 7, amount 1008, and discounted it at 11%, 7 years out, we get the 485512. Year 8, same kind of thing. We notice the discounts going down for these periods here, and then we get down to, what is it, year 16. We have a different amount here because we said from 16 to 20, we're at the 1010 plus the 92, which should be the 1,102 discounted 16 years out at 11%, gives us the 207,498, and 17 years out, discounted to 186,935, and so on. So if we added these up, the total would be the 19,450,000 if we didn't take into account time value of money for 20 years, which is much greater than the purchase price of $7 million. But of course, that's 20 years out. We got to take into consideration time value of money, which if we do at 11%, if we sum up the present value column, we're at the 7,227,414 in terms of the inflow as compared to the outflow of the 7 million. So we could see it's higher. The inflow's higher, which means we did clear the hurdle. We'll talk more about that shortly. But before we do, let's go again and do the same thing and say, okay, we could do this the other way. I could say, hey, these should be annuities. Why don't I make them annuities? We'll do that. Notice there's a bit of a twist if we do it that way. So you got to make sure that you're being careful. And that twist is that when you look at this second annuity, it's an annuity for 5 years, but it's going to be 5 years out from the first time period. So then we got to take a present value of 1 to bring it back to time period 0. So let's take a look at that, including the twist. So we've got years 1 through 5 are years, and then years 6 through 15 and years 16 through 20. So we have then the amount for the first one, once again, is the 710 plus the 62,000 for the years 1 through 5. We will do an annuity calculation for those 5-year time period, which would look like this. We'd say, okay, that's going to be equal to the present value of the rate, which is going to be the 11%, comma, number of periods, which is going to be 5, this time hard-coded because there's 5 periods here, and then comma, this time we're using the payment here because it's not present value of 1, it is an annuity, meaning we are expecting this 772,000 to happen each year for 5 years. So then if we discount that at the 11%, we get the 2853232. Now there's no twist here because that brings us back to time 0. So no twist happens there. The twist happens in 6 through 15 period, where we have the 926,000 plus the 82,000. We do the annuity calculation for it, but we're doing the annuity calculation 6 years from period 0, or 5 years starting from period 0. So we have to do the annuity, and then we got to bring that balance back to the first period. That's kind of the twist. So here's the annuity calculation, present value of the rate, which would be that 11%, comma, number of periods is 10 because it goes from 6 to 15 in terms of the periods, comma, the payment then is going to be the 1,008,000, which we expect to be receiving for 10 years, starting basically 5 years out, the beginning of the year, 5 years, 6 through 15. So then we would get the 5,936,346, which would be the present value as of the beginning of year 6 or the end of year 5. And so then we'd have to bring that back then to the first period. So now we got this amount kind of like at the start, a present value of 1 calculation that we have to bring it back to period 0. So that would be using this formula, something like this. We take the present value of the rate, 11%. Number of periods would be 5 because we're bringing it back to period 0 from here back to period 0. And then it's not a payment situation here because it's not an annuity, therefore comma, comma. And then the future value is going to be that 5,936,346. That then will bring it back to the 3,522,932. So then let's do the last one. It goes from 16 to 20. So that amount was the 1,010,000 plus the 92,000 gives us the 1,102,000. If we do our annuity calculation, which will bring us back to basically 15 years out. So this number is still 15 years out, but it's an annuity for 15 years out to 10 more years, right? 5 more years from 16 to 20. So that calculation would be the present value of the rate, the annuity calculation, the 11%, comma, number of periods would be hard-coded as 5 because it goes 16 to 20. I think I might have said 10 somewhere in there, but it's 5, 16 to 20, comma. And then this one has the payment because it is an annuity. Those things happening, this is going to happen for 5 years, same payment for 5 years. That would give us $4,072,879, but that's happening 15 years out. So now I got to take that amount and bring it back to period 0 using the present value of 1 calculation, looking like this. Negative present value, the rate, once again, the 11%. Number of periods is going to be 15 because this thing is 15 years out. And then comma, comma, because it's not an annuity, therefore no payment. Future value is going to be that $4,072,879, and that then will give us the $851,249. And if you were to kind of compare these to the data we got up top, you can kind of calculate this out and say, is this the same thing, right? You could say if I did this present value of 1 for the first 5 years, you get the 695,495 plus 62. This might be off by rounding, by the way, but pretty close. And then we get the 564,480 plus the 508,540 plus the 458,144. That's going to be the 2,853,232. Should match up the 2,853,232. That looks right. And then we went down from like 6 down here to 16 or to 16 to 15. So that would be here, starting here. 538,918 plus 485,512 plus 437,398 plus 394,052 plus 355,002 plus 319,822 plus 288,128 plus 259,574 plus 233,851 plus 210,676. And I think that's it. So this is easier to do in Excel, by the way, of course. 10 payments. That's going to be equaling the 3522932. So that looks about right. And then if we did the last one here, just to round this out, because it's so fun to do, let's do the calculator again. We got the 207,498 plus the 186,935 plus the 168,410 plus the 151,721 plus the 136,685 gives us the 851,249. So there's the 851,249. And then, of course, if we were to add these up, we get the total over here. We're really looking for this total here. And if I total up the outer column, the 285,3232 plus the 353,522,932 plus the 851,249 is going to give us the 722,7414 about, which matches our total here. So the two methods get us to the same madness. The two methods get us to the same madness. So we're at that's going to be the inflows. If we compare that to the outflow, which we don't need to do anything to because it happened at time period 0, it's kind of boring. The outflow is just what it is. It was the 7 million here. And we subtract the two out, we got a positive number, inflows greater than the outflows, of the 227,417. Remember that doesn't mean that we're basically making 227,417 after interest, for example, just the time value of money, but we're actually clearing the 11% plus some. So meaning if this calculation came out, this difference here came out to be 0, we would still have cleared the 11% or at least met the 11% and therefore might accept the project. And anything above that 0 means that we cleared the 11%, right? That's the capital budgeting net present value kind of theory. If anything's below 0, any negative number would then result in us not having cleared the 11%. And if that being the hurdle rate means we might reject the project, or in this case, the acquisition.